my phone died, so I got ready for bed, and now it's charged up a bit, and now moving on to chapter 15 for the second time because my video didn't save. Alright, so chapter 15, Working Capital Management Introduction. So working capital is current assets such as cash, marketable securities, accounts receivable, and inventories. It also consists of current liabilities, which are accounts payable, notes payable, or bank loans, and accrued liabilities. So net working capital is the total current assets less the total current liabilities. And firms are able to reduce financing costs or increase the funds available for expansion by minimizing the amount of funds tied up in working capital. So short-term financial management. So managing current assets and liabilities is one of the financial manager's most important and time-consuming activities. And there's a constant need to balance profitability and risk while attempting to maximize owner wealth. And net working capital is usually positive, but many firms strive for negative working capital. And as we see, this is more risky, but can lead to higher profitability. So now moving on to profitability versus liquidity. So it's critical to see that profitability and liquidity or cash flow are not necessarily the same, and that a business can be profitable yet experience some serious cash flow problems. So a key measure of liquidity is the length of the working capital or cash conversion cycle, or how long it takes to convert cash back into cash. So the cash conversion cycle, we're going to define and calculate that now. So the operating cycle is the time between ordering materials and collecting cash from receivables. And the cash conversion cycle is the time between when a firm pays its suppliers or pays its payables for inventory and collects cash from the sale of the finished product. So both the operating cycle and the cash conversion cycle may be computed mathematically. So OC equals AAI plus ACP. ACP is average payment period, and AAI is the average age of inventory. And then cash collection period can be calculated one of two ways. They mean the exact same thing, but just in case, either operating cycle minus average payment period. Oh, hello. Average payment period, or okay, so operating cycle is operating cycle equals average age of inventory plus average collection period. But then the cash conversion cycle is operating cycle minus average payment period, or average age of inventory plus average collection period minus average payment period. So strategies for reducing the cash conversion cycle: turn over inventory as quickly as possible without stockouts that result in lost sales. Collect accounts receivable as quickly as possible without losing sales from high-pressure collection techniques. And pay accounts payable slowly as possible without damaging the firm's credit rating. So trade-off between profitability and risk. With your current assets, you're going to have a low return. Fixed assets, high return. Current low liabilities and net working capital that's less than zero, you're going to have a low cost. Long-term debt, you're going to have high cost, and equity is going to have your highest cost. So your goal is to have negative net working capital, and that's an aggressive strategy with higher risk but a potentially higher profit. So a higher profit on the current asset side, so fewer assets equals lower financing costs, fewer bad debts on accounts receivable, less obsolete or old inventory, and it forces the speed and efficiency and reduces costs to win new customers. And then as far as higher risk on the current asset side, so it's higher risk because of lost sales, because of the tough credit policies and low inventory. as well as your production problems from low inventory, your liquidity and solvency issues from low cash, and being unable to pay bills as they come due. Then you have your higher profit for your current liability side. So short-term financing is less expensive or it's free. You have stability, you get your funds quickly, lower flotation costs, fewer covenants, and you're not paying for unneeded financing. Higher risk for current liability side because of the availability and or rollover risk, the variable or unpredictable interest rates, liquidity problems, repayment difficulties, and the high cost if you're paying late. Moving on to accounts receivable management introduction. So to compete, most firms extend credit to their customers and use credit as an incentive to attract new customers. And for the average firm, receivables represent about 15% of total assets, so it's a very important activity. The average collection period is a part of the cash conversion cycle, and the goal is to reduce the average collection period. So the objective for managing accounts receivable is to collect accounts receivable as quickly as possible without losing the sales from the high-pressure collection techniques. So key topics include credit selection and standards, so who gets the credit and how much, then credit terms, so your 210, net 30, and then credit monitoring and collection methods. So a firm's credit terms specify the repayment terms required of all its credit customers, and credit terms are composed of 3 parts: the cash discount period, and the credit period. So for example, with credit terms of 210 net 30, the cash discount is 2%, discount period is 10 days, and the credit period is 30 days. So collection methods include policies and procedures for collecting from late payers. Effectiveness in this area can be evaluated by looking at the level of bad debts. And in general, funds should be expended to collect bad debts up to the point where the marginal cost exceeds the marginal benefit. So moving on to credit monitoring. So the ongoing review of firms' accounts receivable is to determine whether customers are paying according to the stated credit terms. If they're not paying in a timely manner, credit monitoring will alert the firm to the problem, and they show payments are costly to a firm because they lengthen the average collection period and thus increase the firm's investment in accounts receivable. And 2 frequently used techniques for credit monitoring are average collection period and the aging of accounts receivable. So now we'll be moving on again to the accounts receivable trade-offs. So trade-off between profitability and risk, and you assume relaxed credit standards. More sales equaling more profits, ? Because more risks or costs with funds tied up in accounts receivable, bad debt losses, and higher credit department overhead. So the key theory is that a firm should lower quality standards for customers as long as the profitability, there we go, from resulting sales exceeds the added costs of carrying the accounts receivable. And the objective is to be tough enough to get timely payments and minimize bad debts, yet not create ill will and lose customers. So an accounts receivable is a short-term loan to a customer, in other words. So for changing credit standards, so changes in key variables resulting from a relaxation of credit standards. If your sales volume increases, it has a positive effect on your profits, whereas when your investment in accounts receivable and bad debt expenses increase, they have a negative effect on your profits. On the flip side, when you have changes in key variables resulting from a tightening of credit standards, your sales volume, when it decreases, will have a negative effect on your profit. However, your investment in accounts receivable and your bad debt expenses will also decrease, which also has a positive effect on your profits. Lots of time twisters in there. Okay, next page. So as for your cash management and types of float, you want to collect funds as quickly as possible and disperse your funds as quickly as possible. in order to minimize the cash conversion cycle. And you want to have an efficient management of excess cash, determine the appropriate level of cash, and the management. As for the management of receipts and disbursements, collection float is the delay between the time when a payer deducts payment from its accounts and the time when a payee actually receives the funds in a spendable form. And disbursement float is the delay between the time when a payer deducts a payment from its accounts and the time when the funds are actually withdrawn from the account. Both the collection and disbursement float have 3 separate components, which are mail float, processing float, and clearing float. So mail float is from the time when a payer places a check in the mail to the time when it is received by the payee. Processing float is from the receipt of a check by the payee and the deposit of it in the firm's bank account. And the clearing float is from the deposit of a check and the actual availability of the funds, which results from the time required for a check to clear the banking system. So each benefits payer to the deterrent of the payee, to slow disbursements, increases float, and to speed up receipts, reducing float. So as far as speeding collections and slowing disbursements go, a lockbox system is a collection procedure in which payers send their payments to a nearby post office box that is emptied by the firm's bank several times a day. And a lockbox system reduces the collection float by shortening the process float as well as the mail and clearing float. And controlled dispersing involves a strategic use of mailing points and bank locations to lengthen the mail float and clearing float, respectively. And this approach should be used carefully, however, because long payment periods may strain supplier relations. Moving on to investing excess cash, so key factors to consider are return, risk or safety of principal, and secondary market liquidity. As far as investing in market securities goes, so Treasury bills are issued by the U.S. Treasury, and they're issued weekly at an auction, sold at a discount, and have a strong secondary market. Their initial maturity can be 4, 13, and 26 weeks, and it's got the lowest risk and return. It's actually virtually risk-free. As for Treasury notes, they're also issued by the U.S. Treasury. They have a seated interest rate, and interest is paid semi-annually with a strong secondary market. Their initial maturity is 1 to 10 years, and the risk and return are low, but they're higher than the U.S. Treasury bills. Treasury bonds are also issued by the U.S. Treasury. Bet that one surprised you. Anyways, so they have a stated interest rate, interest paid semi-annually, and a strong secondary market. Their initial maturity is 11 to 30 years, and their risk and return is less than corporate bonds, but higher than U.S. Treasury bills and notes. And then you have the federal agency issues, which, guess what? These ones are issued by the agencies of federal government rather than the U.S. Treasury. So they're not an obligation of the U.S. Treasury, and they have a strong secondary market. Their initial maturity is 9 months to 30 years, and their risk and return is slightly higher than U.S. Treasury issues. And then you have commercial paper, which are short-term unsecured notes issued by quality companies. Their yield is very low, but they're higher than the Treasury bill rates. So a couple motives for holding cash. Ooh, my phone's running out of battery. Transactions, emergencies in the business downturns, taking discounts, investment opportunities, enhancing your credit rating, stock buybacks, and dividends. So thank you very much. That was Chapter 15.